Stock Play of the Day is an educational program. Any statements made by Ally Invest employees are not intended to be or should be considered investment advice, a recommendation to buy, sell, or hold a security, or a recommendation to adopt an investment strategy.
Now, anything can happen at any point in time. And you'll see a lot of activity. Those are the trades that I'm proud of. Hello and welcome to the Stock Play of the Day. My name is Brian Overby. I'm the Senior Options Analyst at Ally Invest and author of the Options Playbook. Well, as far as the market is concerned, picking stocks is definitely not a simple thing to do. Finding volatility, well, that's much easier. And so today we're going to actually just chase some volatility in the semiconductor industry. Now, semiconductors are a very odd beast in that the world at this point in time cannot survive without semiconductors. We ran through an issue during the pandemic where they just could not supply enough. There was an immense demand for semiconductors, and there still is. Almost every single thing that is produced in this day and age needs some type of computing system, which means it needs semiconductors. With that all said, the industry is getting beat up. You have a lot of issues going on in China. You have still, even though increased demand, you're just still having supply constraints. And because of this and because of where the economy is at, we're seeing the semiconductor industry just getting beaten up in general. So with that said, there's a lot of volatility in it. So where is the bottom? Well, that is a real tough question. We have big data coming out this week. All eyes are going to be focused on the CPI numbers that are numbers that are going to be coming out on Thursday. We have a Fed meeting that's in November, and the Fed's going to really be reacting to the CPI. Still calling for increased inflation. Would be a real good sign if we could just get the CPI to go down a blip, just so that it was going in the right direction. Looking at 0.75 basis point move again in February. We're looking at the Fed Watch tool over on the CME, Chicago Merc Exchange, still showing about an 80% chance that the Fed is considering a 0.75 point move. Markets are reacting. We made it through September, just barely, but September proved once again to be a very volatile and scary month. We are halfway through October, and then hopefully we can get into some just cheery times. We got some holidays. We got Thanksgiving. We have the Christmas holidays. We have the shopping that could help stir and get the markets going. We talk about as the year ends, maybe we could get a Santa Claus rally this year. That would be really nice in the markets. So considering how much everything is beaten up, we also had very bearish sentiment. We had Jamie Dimon come out and mention that we might not be at the bottom, that there's a potential for another 20% move to the downside, which means we'd be looking at the S&P 500 index below 3,300. And speaking of that, right now, if I show my VIX watch list, we are now currently seeing the S&P 500 index at 3611. It's down flat on the day. It was down most of the morning. And so we have the NASDAQ once again leading things lower, down 0.5%. The Russell has now just gone positive. This is the ETF that tracks the Russell. But the VIX index has definitely been a story. We've been talking about it here on the Stock Play of the Day forever, and that if you look at the VIX, gosh, it hung around the 20% level all the way through the summer, and now we're finally seeing it live up to its name, its nickname. It's known very well as the Fear Index. So we're finally seeing some fear in the volatility index, and we're north of 30. And it looks like we made a bounce in August off the 20 level, very close to that, and done nothing but gone up since then. So even if we look out in the futures, we look out to January, we're still seeing the VIX trading right around that 30% level, hinting that this volatility just isn't going away in the short term, and there's still a lot of nervousness. So hard to be bullish on almost any sector. Energy sector has done really well, but it turns out that Europe seems to have been planning pretty well for the winter season, and a lot of their stockpiles are full. So without that black swan type of event, which is still obviously out there because of geopolitical concerns and well, just anything that might tip the scales, Europe is doing better than expected. And that economy has made the greenback really strong, kind of affected some of the earnings, and we are going to be kicking off another earnings season here. And a lot of the concerns are on the bigger corporations, the S&P 500 index corporations, and the effect that the dollar, the strong dollar, is going to have on their earnings. A lot of people are anticipating a 6 to 7% decline in earnings and earnings forecasts going forward. And I think the forecasts are what are really going to matter. Good things that could happen is that we do see a decrease in inflation, that we can finally say, well, maybe inflation has topped. I have no idea, but I think everybody's going to be watching that number. So where does that lead us on the Stock Play of the Day? You could get bearish, and we've done a lot of bearish trades. Some in the NASDAQ. We focused a little bit on Meta, i.e. Facebook, and did some bear put spreads. With that mentioned, I'm just going to chase volatility. I'm going to flip a coin in the semiconductors. I'm going to run over to the semiconductor chart, and we'll see that it's pretty ugly. It's actually uglier relative to the S&P 500 index chart from its highs. Its highs, well, we're looking at the SMH, and I should let you know what we're actually looking at. The SMH is the largest ETF that tracks the semiconductor industry, and this is what we're going to play with today, or it's going to be our paper trade, is in the SMH. But if I jump over real quick to the chart in the S&P 500 index, I clicked over one too far, you see that we got a very similar type pattern, except for the drawdown is bigger in the SMH. Real ugly as far as moving averages is concerned. We have the 20-day way below the 50-day, which is way below the 200-day. I run back to the SMH chart, and we have a very similar scenario. We're just off the highs. We're all the way up here, going all the way back to, well, December and January, the beginning of this year. 317 in the SMH. We're all the way down to 176. So for this year, we're setting new lows in the SMH. Once again, I don't think the industry is going to go away. I don't know if I want to bottom fish and be buying here, because who knows where that bottom is at. Jamie Dimon definitely thinks that there is a potential for the markets to go lower. And, we're finally getting a little bit of I think in a weird way, it's good that we're seeing the VIX index up above that 30% level. We still haven't had that big spike that I've been looking for, that I've talked about, where the VIX just spikes up to the 45, even 50 level, and then starts backing off, where we could say, okay, this may be a moment of capitulation, and maybe this could be the bottom. Everybody's is still fishing for it, but right now, The sentiment is definitely not that we are at a bottom, or even that inflation is waning at this point in time. So let's just chase a little bit of volatility. We're way down. Look at these three red bars here over the last 3 days in the semiconductor industry. We broke, this was a small area of support. Notice we bounced in that area in the lower right-hand corner. 1, 2, 3, 4, 5 days, made a move back up to the 20-day moving average, and now we're just looking ugly. Okay. So I'm going to sell a short put spread. One could say that maybe we should go the opposite way and sell a short call spread. Don't mind that either. The concept of doing the short spread, though, is going to be the same on the call side as on the put side. So a short put spread, and I'm going to highlight this inside the options playbook, the book that I have authored. This is the companion website. If we look at a short put spread, what we are saying is that we're going to go below where the current market is at. We're going to sell a put to bring in a lot of premium, considering where the VIX is at and where the volatility of all the semiconductor stocks are at. And then we're going to buy some protection below that to try to offset some of the risk. So the question is, so the stock, as far as this profit and loss graph, this is at expiration. All of our risk comes from selling strike B. The stock is up in this range, right? It's somewhere way up here. And we're going to try to get far enough out of the money where we can still bring in some premium, but have a decent chance of these option contracts not finishing in the money and hence making a profit on your trade. So how are we going to do that? I'm going to run over to the Ally Invest option chains. Let me find them real quick like. And we see here, here's the semiconductor industry. Here's the index right now, down 3%. I'm sorry, the ETF, SMH, we're down 3% on it, down 560 on the day. Market's a little flat, a little bit scary to be playing in this index. So we're going to really be cognizant of managing our risk. All right, and I'm going to adjust the trade because we're down a little bit more than when I first was looking at it. So we're at 176. So if we look at the 175 strike put, we're going to go out only 10 days. It's going to be a very short-term trade, mainly because there's so much volatility in this index. S&P 500 index is trading, well, the VIX is, the 30-day VIX is at 30% implied volatility. We're looking at this 10-day option contract. We see it's trading at about a 50% implied volatility. What I want to pay attention to is what's the most at-the-money straddle trading at? That most at-the-money straddle in this instance is the 175, 170. There's not a good at-the-money number here. 177 would be great, but we don't have that strike. So $5, let's call it about 11 points out of the money. So if I look at that, if I go about 11 points out of the money, that's where I'm going to focus selling my short put. And just a little hint, if you do that, you're going to end up with a delta on that short put right around 80%. That means you got about a 20% chance of the underlying stock at expiration finishing 1 cent in the money. Not necessarily losing on the trade. We're just saying of the stock finishing below that strike. And there's two ways that you could do this. You could go out and you could look at the delta and say, I just want to sell something that has about a 20 delta, and that would be the put that I would be selling. Or if I look at the expected move, which means I look at the most at the money strike and add those two together and then subtract, and I should be very similar as to what put I'm going to be selling. So just very quick, and if I'm doing it on the call side, I'm just going to add it to the most at the money, to the current stock price, and also should be very similar concept in that if we get that far out of the money on the call side and we look to do a short call spread to try to take care of some of this volatility, well, in that instance, we should be getting a very similar type trade with the risk reward as we would on the put side. Now, if you have any questions about that, feel free to put them in the chat box. I'm going to try to address them at the end of the show. This is an open forum. It's part of the reason why we're doing it here on the Ally YouTube channel, is so that we can try to address your questions. And we always are taping live, so we're using live quotes as we do this. And because of that, we always have to say, well, this isn't necessarily meant to be a recommendation. We're just trying to learn here on the stock play of the day. Okay. So I'm going to clear this out, and I'm going to go down one more strike. So we're going to sell maybe we'll stay at the 160, 165. Yeah, I don't mind this at all. Okay. So because we have live markets, I'm going to adjust the trade. 177 minus 11, we'll call it 10, is about 165. Since we don't have any strikes in the middle, we only have a 165, 170. If we sell the 165 strike, we're actually got right at a 20 delta. So the numbers don't lie. It's almost always going to be the case that if you go approximately the expected move out of the money, your delta is going to be fairly close to that 20% level, or 0.20. Okay. So I'm going to sell the 165 put, and I'm going to buy the 160. At this point in time, we're getting that done for about an 80-cent credit. Not too bad. I would like to get $1 if I'm doing a 5-point wide spread, but we'll take 80. 80 is okay. It doesn't make me run from this trade. So the maximum upside that we can get on the trade is going to be that 80 cent. That'll be the net credit to the account. Our maximum downside would be the width between the strikes, which is $5, minus the net credit received of 80 cents, or $4.20. That's my max risk on the trade. So this is going to be the official paper trade. It's only going to be a 10-day trade. We're hoping that the market can make a little bit of a bounce back after being down for so many days in a row. That's really what we're looking for here. And we're hoping that the semiconductor can bounce just like the market may. Now, if it did come down to this level, that 165 level, would I be willing to buy it there? Do you have capital to allocate? Could you buy 100 shares at 165, $16,500 if you were put the stock? You can obviously use the credit of 80 cents to try to help pay for it. But that would be another way to approach this, as I don't want to just sell a put saying that I'll buy the SMH or the semiconductor ETF at a lower price, because I don't want to take all that risk. Markets are still really volatile. But if it did come to that level, well, gosh, now we're at obviously recent lows in the SMH, and maybe I wouldn't mind owning 100 shares of it at that level. Okay, so now the market's moved, and now it's at 75 cent net credit. So we'll use the live number. We're going to go at the midpoint. Very, very liquid markets here in the SMH. So I would assume that we could trade somewhere close to the midpoint, but there's never a guarantee of getting that. We'll put a 75-cent credit. So they took a nickel away because I was long-winded here in my explanation. If we sell this trade on a one-by-one basis, we're going to bring in a $75 net credit to the account, 0.75 times 100, less commission to put on the trade. And that would be our paper trade for this week. So looking to sell to open one of the October 21st, 2022 expiration, 165 strike put, and at the same time, buy to open that same expiration, 160 strike put, entering it at a limit net credit of 75 cents to the account. No guarantee that we'll get filled at that level. Hopefully we will. We're going to try to work the order a little bit, and our maximum upside would be $75 for every one-by-one spread that we do, less commission. Our maximum downside would be $5 minus 75, or $4.25 plus commission. All right. So we'll take a quick peek at the profit and loss calculator. While I'm doing that, please put your questions in the chat box. And a little bit of a short and sweet episode. I had a little bit of time off. I actually had a little PTO last week. So because of that, I'm not really going to go back and review the other trades. We do have some trades that we do want to look at that were a little bit longer term trades. So we'll go back and rehash them probably next week And this trade will obviously play out. It's only got 10 days worth of trading before the expiration of these option contracts. So in the Ally Invest profit and loss graph, here's what we have. Here's where the underlying stock is trading at, right around 177, 178. On the downside, as soon as we do this trade, the colored line shows you the profit and loss graph. If it goes up, we're profitable. If it goes down, we're losing. If it goes down in a hurry, all the way down the expected move, well before the expiration date, well, I would think about maybe closing this trade out. And some people will ask, well, what's our plan? Quite simply, if you put it on for 80 cents and you want to try to adjust it, my goal would be that if I lost 40 cents on the trade, if it was trading for $1.20, I would consider closing it out. I don't want to lose the maximum on the trade, which would be 180. Oh, well, I'm sorry, 160. That means that the maximum I can make is 80 cents. So I'm going to try to limit the maximum loss to 80 cents, and that would be 160. You decide where your risk parameters are at. If I were closing out this trade, if, let's say, over the next 5 days, the market went up and I could close it for 20 cents or 15 cents, I'm almost always going to take that risk off the table. 1 second here. If I can make 80 to 90% of the premium that I received on a short put spread, on a short call spread, on an iron condor, I'm almost always going to go and close that out and take that risk out of off the table. Especially that last dime of premium is really hard to capture on short spreads. So just always keep that in mind. As expiration approaches, it might seem it's way out of the money, especially in a semiconductor industry where the volatility is high. You always want to be a little bit nervous. And if you can capture most of the profit, I almost always want to do that. All right, so if I look at the questions here, right now, I don't see any questions. This is going to be your last call for questions if you want to put them in the chat box. And if not, oh well, go ahead and give us a thumbs up if you're enjoying the show. Click subscribe, ring the bell, get all the notifications, share it with your friends and family. Well, Devin, I also appreciate, I missed your comment. Good afternoon, we missed you. Yeah, welcome back. It's great to be back. It was great to get away, but it's always good to come back. And please share this with everyone. It's free for all. You don't have to have an Ally Invest account. That's part of the reason why we do it here on the Ally YouTube channel. Thanks for coming, everyone. We'll see you this coming up Tuesday for the next stock play of the day.